Good morning from our world headquarters in New York. I'm Menace Cranny. Danny Berger is out for the rest of the week. Let's set your agenda on Bloomberg Brief. Mester and Daly say a trio of rate cuts this year are still on the cards, although they are in no rush. Presidents Biden and Xi speak for the first time since November. AI, risks, Russia and fentanyl are on the agenda. Taiwan is hit by the worst earthquake in 25 years, killing at least 7 people, disrupting the chip production. We are live to Taipei. Breaking news for you hitting the Bloomberg terminal now on Europe. European CPI. This is what we have for you. The year-on-year number comes in less than estimated at 2.4%. The core reading also coming in tighter than the market had estimated. This is the month-on-month reading at 0.8%. The market had penciled in 0.9%. Very first reaction in the euro there, just fairly flat at the moment. So these look on the headline to certainly be beating on the CPI, on the headline by 0.1%, on the headline CPI, and on the core coming in at 2.9%. Of course, services inflation has been stuck at around 4% for the past number of months. We know that food has been one of the biggest contributors to the decline in these numbers. Unemployment rate comes in, ticks up ever so slightly to 6.5% from 6.4%. As we get more market reaction, the euro's virtually flat on that. Let me give you a quick snapshot of what's going on across the rest of the markets. Equities are on the back foot. To a certain extent, you have this reaction function in the equity market finally to the higher for longer narrative. The Nasdaq dropped by 1% yesterday, adding to that on the downside. Tesla was one of the big laggards. The Russell, of course, down by nearly 2% yesterday. MSCI Asia down 0.7% on the back of this earthquake in Taiwan, the 7.4 magnitude earthquake. A couple of individual stocks to keep an eye on as a result of that earthquake in Taiwan. You are looking at a number of ramifications. Taiwan Semiconductors down by 1.25% at the moment. There was a tsunami warning around the rest of the region. One stock to keep an eye on as well from the American perspective is Intel. Their foundry business, the chip-making business, delivered losses of $7 billion. We were updated last night. That's up from $5.2 billion and will not break even until the year 2030. Roll it over, have a look at the bond market. I would say that the bond bears are in charge, not the vigilantes. You are seeing a third day of a rise in yields. You've hit the highest since 2024. We're counting down to this jobs report on Friday. Torsten Schlock at Apollo reckons we're going to get a hot and solid number. We've got Fed speak. We'll talk more about that in a moment. Marija Veitmane is in no urgency to adjust her rates, but sees 3 rate cuts as a baseline. Gold did make it to a headline this morning, a new record this morning, although open interest is falling. And New York crude up 0.1%. The inventory slip. We'll have Bob McNally a little bit later on in the show to talk about geopolitical risk and supply issues in the oil market. But my next guest to kick off today's show writes this about the strength of tech. Under the surface, we're seeing corporate earnings, stock performance is weak outside of the IT sector. Not surprisingly, investors are favoring the safety of quality trades. Our favorite trade is cash and tech. The barbell. Marija Veitmane joins me now, Senior Multi-Strategist at State Street. Marija, great to get you with me this morning. We've had this little bit of a shakedown in the market. You talk about what's going on under the hood. I would put it to you that these equity markets, Marija, have traded with a certain amount of impunity to a higher for longer narrative, and that's just been tested. Good morning.
Yes, good morning, Manus. And I think it's really, it's really interesting to think about equity markets right now. I think there are 2 kind of almost parallel narratives running. One is that macro narrative, which is soft landing, inflation coming down, growth is still okay. Central banks are going to cut probably 3 times this year. Rate cuts are coming, so volatility is low, and that's supporting equity market. So that's your kind of positive story. But then under the hood, you get all these micro stories where we think layoffs, earnings coming down, banks are not lending, kind of manufacturing slowdown, China slowdown, and that's really kind of pulling earnings down. So you have this macro and micro conflict. And on the macro side, that's supporting momentum, stocks are rallying, but if you look underneath, is, it's actually quite a select group of stocks as running. So it's still tech-led, it's still quality market cap, like large cap-led. So that's the story for us. So it's really about selectivity.
So this macro-micro conflict that you talk about, are you upping the amount of cash that you have, Marija?
Sorry, can you?
Are you raising the amount of cash? You talk about the barbell approach that you have, which is in tech and cash on either side. My question to you is, are you raising the level of cash that you have in the portfolios at the moment?
That's a good question. I think yes, we'll probably raise cash. And so there are not much else we like. So cash investors are already overweight the tech stocks quite substantially. That's a big position they're running. Everything else, I really struggle to find what else do I like. So yeah, I think you're right. Allocating a little bit more to cash makes sense.
There is this narrative out there that positioning is not stretched, that there's no extreme mania in these markets. Would you agree with that?
I think, again, on average, it's absolutely right. It's not stretched. The position in equity holdings are not as extended as we've seen in the past and in the previous so-called bubbles. But if you look at tech specifically, yes, our kind of estimates of investor positioning through our custodial holdings in tech sector, it's the highest outside the tech bubble. We haven't seen bigger position in tech. Then the big question is, does it make sense? I mean, perhaps, given that tech sector is so much more profitable than other sectors, it's so much more reliable, and kind of now we're kind of tapping into the new source of revenues with AI kind of excitement. So yes, tech holdings are as extended, I mean more extended than we've seen outside tech bubble, but perhaps that's understandable. Other sectors, other regions, not particularly extended.
Marija, you talk about the macro versus the micro, and I just want to revert back to the macro, because one thing that did stand out for me was your call on recession. Now, it's interesting that I've had you on today. I've had UBS, Banu Baveja with me, Yassi, talking about the tail risk, the fatter tail risk that is underpriced in markets is a slowdown in growth, which is not the consensus narrative. There's no dramatic consensus narrative for a slowdown in growth. You actually use the word recession. We expect the US to slip into a recession. I'd call that slightly contrarian at the moment, no?
I think it's quite a nuanced call. So we think that current economic situation in US is actually quite robust, which means that rates, it's difficult for Fed to cut interest rates. I think three cuts is a stretch, and the longer the interest rates stay higher, then we will begin to see problems. And the way we see problems coming along is through a kind of financing channel. We already see borrowing funding costs increasing quite substantially, particularly for smaller companies. So there, I mean, I quite like to look at things like net interest expense to EBITDA, and that's the highest in a decade for smaller companies.
But when does that bite? When does that bite? Does that bite in the back half of this year, Marija? And then, you know, what is the consequence of that? Because if we fall into recession, then you and Banu Baveja can go for lunch, because he's calling for 5 rate cuts in 2024.
Well, I think that's quite punchy, but I think it's already biting for a lot of companies. I mean, if you think about Q4 earnings report, I think it was quite hard to find many reports when companies didn't talk about layoffs, didn't talk about difficulty to like margin squeeze and difficulty to pass higher costs. And we see that in like companies with a lower margin. So things of your like consumer staple companies where margins are quite low, they're really struggling. They're really struggling to pass higher costs to consumer. So I think we're probably parts of the economy is already in recession. I mean, fortunately, US is a huge service economy, which has supported by labor market, by fiscal impulse. So there are still parts that are supported, but arguably that's on borrowed time as well.
Okay, so focused on the net interest to EBITDA. We're seeing the oil markets strong, robust. Geopolitics is in part fueling that. I would say that actually there's very little geopolitical risk, maybe a buck. Bob McNally puts it down as $1 geopolitical risk, and the rest of it is a tightening market. When you look at energy markets, there's a macro impact and there's a micro impact. Dissect it for me.
I mean, oil is challenging because normally you would think about like demand forces are quite similar between energy and material, so oil and kind of industrial metals. And we're seeing very big divergence between prices of, say, things like iron ore and oil. So to me, actually, there is a lot of kind of supply and geopolitics that's driving oil prices. So that's a big concern. And I mean, increasingly, we're seeing that coming up and up. So I do worry about geopolitics and kind of market nervousness around it. So maybe in reality, there is not much oil pulled out of the market, but market is really worried about it. And we see kind of premium paid for oil as opposed to kind of other commodity sectors.
Indeed, and we now have the earthquake, the unfortunate earthquake in Taiwan to deal with, and that certainly can have reverberations around the supply chain, potentially within chips. Marija, thank you very much, Marija. Joining me this morning, setting the agenda, the macro versus the micro, is the trade from Marija Veitmane. Other stories trending on your Bloomberg terminal this morning. U.S. regulators, led by the Fed, have blocked tough global climate risk rules for U.S. banks. That's according to people familiar with the matter. European central bankers have been pushing the Basel Committee to require lenders to disclose strategies on green commitments. In closed-door meetings, U.S. officials cited their narrow mandate and the concerns that the Basel Committee were overstepping their purpose. Reuters reports that Disney has secured enough shareholder votes to defeat a challenge against a board mounted by Nelson Peltz. Elon Musk says that while he doesn't own Disney shares today, he would definitely buy it if Peltz was elected to the board. Donald Trump has sued two co-founders of his newly public Trump Media and Technology Group. Trump claims they set the company up improperly and shouldn't get any stock in it. Trump Media shares plunged less than a week after going public. And the comedian Jon Stewart says that Apple told him not to interview antitrust enforcer Lina Khan when he was still working for the iPhone maker. Apple currently faces a suit from the Department of Justice. Before returning to Comedy Central's The Daily Show this year, Stewart served as the host and executive producer of Apple's streaming services. The problem with Jon Stewart. Coming up, it is the worst earthquake in 25 years. It hits Taiwan. We get the details next. And the presidents Biden and Xi talk over the phone in their first one-to-one exchange since November. From AI to Russia to drugs. We'll have the details on Bloomberg. It is Bloomberg Brief. I'm Manus Cranny in New York. Now, an earthquake of 7.4 magnitude has hit Taiwan, killing at least 7 people and causing the chipmaker TSMC to move its staff out of production centers. This is the worst quake in 25 years. Adrian Kennedy is in Taipei for us. Adrian, good to see you. Good to see you safe. Give us a sense of the developments on the ground, the scale of this quake, and just how much impact it's having on Taiwan, the country.
Good morning. So a little bit before 8 a.m. we were struck by a 7.4 trembler. That is indeed the strongest since 1999. It struck in the east of Taiwan, in Hualien, which is a relatively underpopulated compared to the western part of the island. This is an island of 23 million people, which is critical to world chip supplies. It's a major technology powerhouse, but the majority of that is on the west of the island. Now, when the quake hit, it was felt very strongly in Taipei, where the subway briefly shut down and buildings were swaying. It was extremely strong. However, very quickly, life in the capital, Taipei, resumed. Stock markets traded as normal. It dropped about a percentage point today. But the real events appear to be in Hualien in the east. Now, that is relatively remote. We have a death toll so far of 7 people. About 800 people have been injured so far. There are people trapped over there in collapsed buildings. We've got more than 24 collapsed buildings, and we understand that in a tourist area known as Taroko Gorge, there have been rock slides and possible tunnel collapses. On the west side of the island, closer to China, where the majority of the island's industrial base is found, as you said, a number of companies suspended operations periodically to try and mitigate the impact from the quake. So we had TSMC, UMC, and several others evacuating staff and briefly
just on that,
suspending production.
Let's just pause for a moment because obviously two very, very separate issues. One is the human side, as you say, and life in Taiwan. And then there is this industrial impact. And one of the big discussions around the world has been the concentration of chip production on Taiwan, which, as you and I were talking in the break, is somewhere where this happens. You have tremors and tremblers really quite often. But is it a step up to see TSMC move some of their staff out of the production facility? The stock's down nearly 1% this morning, which is not a huge move, but it's not insignificant. Just give us a concept of the supply chain interruption or the risk of supply chain interruption here.
That's a very good question. We don't quite know the full impact yet. From the prima facie, it looks as if they took a precautionary step. They underlined to us that it was a procedural action. They've previously suspended activities or modified their activities at their fabs when there have been typhoons, for example. And I think that this is a sort of behavior you expect from a major technological producer whenever there is an event like a typhoon or an earthquake. That said, Barclays has put out a report saying they're going to need to monitor developments. It's possible that what's happening on the east part of the island, where we've had trains disrupted, where we've had highways blocked and roads cave in, that could lead to some sort of supply chain impact.
Okay. Adrian, stay safe, and thank you for reporting that. It's Adrian Kennedy in Taipei on the earthquake. Quick snapshot of what's going on in commodity markets. You've taken out records in gold. You've had copper trading above $9,000 and solidly above there. Crude remains a bid up 0.25%. Gold comes back from its new record high. We've got a fall in the open interest there, so maybe a little bit of short covering going on in gold. Good morning from New York. This is Bloomberg Brief. I'm Manus Cranny in New York. The US and China are ramping up their communications. Presidents Biden and Xi getting on the phone for the first time for one-to-one discussions since November. Well, the Treasury Secretary, Janet Yellen, heads to Beijing this week. Anne-Marie Hordern joins us in the studio. So we're in full election mode now, aren't we? Or am I being too skeptical? And this is about pragmatic steps to rapprochement with China.
I think it's both. It's pragmatic steps. These two individuals, when they met in November in California, said that they were going to want to keep communications open, whether that's things that they can agree on, like AI, like climate, military-to-military communication. They wanted to make sure that they can keep the line of communication open. At the same time, it is an election year. And I think also from Xi Jinping's point, he does want to put a lid on the tension and acrimony you see from Washington and Beijing. He just had all these executives.
I was going to say, he's just had Pfizer,
town.
he's just had a bunch of CEOs in across the door to go welcome, and that's all about FDI.
All about FDI. It's at, what, a 30, 40-year low. He needs to get that investment back in, and he needs to revive his own economy. And at that point, you don't want to have a tit-for-tat with the United States.
Yeah, but then this is where trust comes in. So we've both looked at this story, and I'm curious to get your take on this. The Chinese media are focusing on the following line: don't flip-flop, don't stir up trouble, and don't cross the line. I wonder would he say that, would he say that to the other prospective candidate that's running for presidency?
I think he would. I think what he potentially, it could be a number of things, right? He's talking about with that line. Is it about Taiwan, how the U.S. sometimes says two things at the same time when they're talking about Taiwan? Or is it also about the fact that the United States is talking about, Secretary Yellen has been talking about this, and she's preparing to go to China as well, the overinvestment, the capacity that China has, the subsidies that they use in their market, and what many say dump on the global market. And at the same time, they're going to the WTO, China that is, with a complaint about the United States' Inflation Reduction Act and their own subsidies and protectionist measures. And potentially that's what Xi Jinping is getting at there with that line.
And then, of course, we've got the Wall Street Journal. Yellen proposed to travel to China. We've got an entourage traveling to the Middle East, we understand as well. But Yellen's preparing for China. What will be the objective of that? What will be the upside of that?
Well, this is really going to be about what she has been talking about recently. Most recently, she was on a domestic pitch at a defunct solar facility in Georgia, and some of these issues that are about U.S. jobs and the fact that because of cheap products coming out of China, they're usurping the U.S.'s own industry. So that is going to be...
Is this about onshoring, or is this about, again, a political narrative? She says in this story, she says, we don't want to be overly dependent, and they want to dominate the market. So this is, again, a domestic message with a global pitch.
Exactly. But it's an election year. And this makes sense from this administration to want to do that, especially as they try to win some of these union votes. They are trying to push this EV electrification of the grid, and all of that is coming out of China. She also says in this story, quote, people like me grew up with the view. If people send you cheap goods, you should send a thank you note. That's what standard economics basically says. I would never again say, send a thank you note.
Message from Anne-Marie Horder there. I'll never send her any cheap goods. Anne-Marie Horder on the political narrative. You'll catch her in Bloomberg Surveillance with the team in 30 minutes. This is Bloomberg. Welcome back to Bloomberg Brief. I'm Menace Crenny in New York. Danny Berger is off for the week. Here's what you need to know. The Fed's Loretta Mester and Mary Daly say they still see a trio of rate cuts this year, although they're in no rush. Chair Powell is due to speak later today. Presidents Biden and Xi speak for the first time since November. AI risks, Russia, and fentanyl, all on the agenda. Taiwan is hit by the worst earthquake in 25 years, killing at least 7 people and disrupting some chip production. We have a live update from Taipei. So these equity markets at the moment are shaken by the rise in yields. They're dragged lower on the NASDAQ by Tesla. There's a sort of a real reckoning here. JP Morgan have said equity markets have so far managed to ignore the pivot within the pivot. The Goldman Sachs unprofitable basket dropped by 3%. Positioning is not stretched. I've just had State Street reaffirm that to me. There is the macro versus the micro. There is a lovely line coming out from Goldman Sachs. They're talking about their prime book. This is important. We have the largest short selling in 6 months, and the largest moves were in TMT stocks, making up 75% of the selling pressure in the prime book, according to Goldman Sachs. We're down 0.3% on SPOOs. MSCI carry the weight of the earthquake in Taiwan around the Asia Pacific, the 7.4 magnitude. TSMC is at the bottom of your screen now, down 1.25%. We understand staff have been moved from production facilities within Taiwan Semiconductors out of that. There may be reverberations in the supply chain. Roll it over, have a look at Intel. They've been a truth and reconciliation moment with their foundry business, their chip-making business. Stock down nearly 5% at the moment. The foundry business losses ramp higher by up to $7 billion, up from $5.2 billion, and will not break even until the year 2030. Roll it over, have a look at the bonds. The Bears had a go. The vigilantes are still asleep, is what I would say to you. We'll discuss that in just a moment with my guest, Blake Gwinn. You've got yields making the high of 2024, up another couple of basis points this morning. You had the biggest two-day rise since the start of February. We're counting down to the jobs report. Mary Daly and Loretta Mester, they're still using the rhetoric of 3 cuts, but do they have the conviction? Gold off its record highs, 22.71, and oil is bid up 0.25%. We'll catch up with Bob McNally in a short time to discuss the geopolitical premium in the oil markets. So it is a big week for Fed speak. 2 officials say that they see 3 rate cuts as a reasonable baseline for 2024.
I continue to think the most likely scenario is that inflation will continue on a downward trajectory to 2% over time, but I need to see more data to raise my confidence.
The labor market is still going strong and growth is going strong. So there's really no urgency to adjust the rate. We need to be sufficiently confident that we're on the right path of rebalancing the economy and bringing inflation down to 2%.
Joining me now is Blake Gwinn, head of U.S. rate strategy over at RBC Capital Markets. So 2 voters, Loretta Mester and Daly, both sort of still hanging on. Are they hanging on by their fingernails to 3 rate cuts? Good morning.
Morning. Yeah, I mean, I think, what you say, hanging on by their fingernails is absolutely right. I think they have this kind of story that they're going with, that the January inflation data, they came in very hot. was essentially like a one-off idiosyncratic kind of fluke. And they just need some proof that that's actually the case. So I actually think there's a lot riding on this next CPI print coming up. Give us a little.
Do you think it was a fluke?
Yeah, and I think that's pretty much consensus as well. I mean, I think people do agree with the Fed that it's coming down, but it just puts a lot of risk on that March CPI report because I think it's really kind of put up or shut up time for this bump in the road narrative. If it doesn't come down.
Oh, don't worry. Transitory lived for quite a long time, but you say it's either put up or shut up in terms of the idiosyncrasy of
the bump
seasonal.
in the road narrative that they've been kind of selling, the last month or so.
How nervous were you over the past couple of days when you saw bond yields up by 15 basis points?
Yesterday morning, I really thought, we were going to take off there for a second. I mean, we've come through some technical levels. I'm looking at your chart here with the 10-year yield at 437. 435, I think, was a level a lot of people were looking at. When we kind of got through that, we tried to break it in February. We tried to break it in March. Didn't quite make it over the hill. And so when we broke that pretty solidly yesterday morning, plus the fact that I think a lot of these momentum type accounts are involved, are getting short, I really thought we could, be in for a pretty quick move higher. But so far, we kind of stabilized. I think we saw some good demand come in yesterday afternoon and, keep that run from occurring, at least in yesterday's session.
So if I said to you, the bears have had a run, but the vigilantes are still asleep, what would you say to that?
The bond vigilante story, we had a run of that, August, September of last year, you remember. Yeah. And I think it's been coming up a lot in conversations recently. I think, that August, September term premium kind of driven run, it's been invoked a lot in conversations I've had with clients over the last few weeks. So it's certainly on people's minds. But I do think the way that played out should have calmed some of those fears about supply. If you kind of remember what happened back in August, we did get an announcement from Treasury that really surprised a lot of people as to the amount of supply that was coming. They had started at that refunding meeting, started increasing the amount of bonds they were issuing. We think that's pretty flat from here. We don't see them increasing those auction sizes again until 2025. So you at least have that kind of off the table. Now, the overall issuance is still very high. Mm-hmm. We're still running high deficits, so I think it's still on people's minds. But I think markets showed back then that they can handle it. And, a month after the kind of term premium scare, supply scare, we were right back down to low yields into December. So
it's amazing how certain narratives build in momentum and then fade. Jay Powell spoke last Friday. The world was unable to trade on Jay Powell's narrative last Friday. We're counting down to his speech today and jobs data on Friday. So they're two quite important narratives. What do you think happens this week? Are you looking for a hot jobs number? Do you think that Powell in any way changes his rhetoric from last Friday?
So I think, if we look at what we saw last Friday, I think it leaned a little bit hawkish. But I think an important thing about Powell, and we also saw this with Waller, is that even though there were elements that were read as hawkish, they're talking about patience and being able to, go into the first cut very carefully. But neither one of them are necessarily precluding a cut in June. They leave that possibility open that we are going to see inflation continue to develop the way that they expect, and that they will be able to cut by June, because they mentioned, they just need to see a couple more CPI prints. We get 3 by that June meeting. So they will have a chance to see enough data to start cutting by then. So even though it reads a bit hawkish, I don't think it precludes a cut in June. As far as NFP this week, I think one thing that was very interesting in the press conference with Powell is that he put this kind of asymmetry on the labor market data, saying that, if we get good labor market data, that's not enough to keep pushing those cuts out. But if we get bad data, it could certainly pull them forward. So I think there's a bit of asymmetry where if we get a weak print, the markets probably start pricing in more cuts at the front end. If we get a strong print, we're probably kind of pinned at the front end, and really what you get is the back end raising. So I'm biased towards steepeners.
Okay, and I think that, again, that seems to be a building consensus. Looking at the JP Morgan survey, and I was sort of struck by this morning, for positioning. JP Morgan have the biggest, in their client survey data, the biggest outright shorts since January the 1st, which is, okay, we've had a little bit of a bump in yields, a little bit of a sell-off in prices in the past couple of days. How would you describe positioning?
It's kind of funny because I was a bit surprised by that as well. Just in a lot of my conversations, particularly more in the real money type of space rather than the fast money hedge fund. But a lot of my conversations have suggested that they still remain somewhat long, maybe a little bit less long than they were at the end of last year, even coming into January. But I think they still remain in those long positions. And outside of that, I think people are fairly neutral. on rates right here. I think what people have kind of shifted to is that without this high conviction view on where rates are going, we're in this kind of hold period now. You know, you had the big hiking cycle. Now we're just waiting for the cutting cycle. I think people have kind of moved away from those high conviction directional views. They're looking for spots to add carry or to find ways to kind of eke out some returns without taking those big views. So I think people are actually fairly neutral on duration, on the direction of rates right here.
And do you think that that permeates across credit and across high yield? Is that sort of neutral? Would you say that neutrality is pervasive, not just in sovereign?
Yeah, and I think one of the places we see it showing up a lot too is the vol space. So we've, you know, a lot of the collecting of carry is people selling vol, and we've seen vol, you know, come down quite a bit. Implied vol has kind of collapsed over the last month or so, and I think a lot of that's because people are just selling that, try to eke out some returns when you don't think there are going to be big directional moves in yields.
Okay, let's leave it there. I'm reminded of selling volatility and selling put options in 1994. It was great for a while. Until
it's always great until it's not.
Until it's not, and then you have a few margin calls. I can assure you, Blake. Thank you so much for being with us this morning. That is Blake Gwinn, my guest this morning on the bond markets from RBC Capital Markets. Let's just give you a snapshot. There was a blow up in yields yesterday. It was a global blow up in yields. Now, to a certain extent, U.S. yields continue higher for the third straight day. Let's see what Jay Powell says today. There's a small moderation in UK and German yields this morning in the market. Coming up, we're going to discuss the oil market. Bob McNally, founder of Rapidin Energy, joins me on the scale of war premium in these markets. This is Bloomberg. It is Bloomberg Brief. I'm Menace Cranny in New York. Oil is holding its ground. The rally ahead of the OPEC Plus meeting. Our next guest writes this. Rapidin has long asserted the oil market was too complacent about the Iran contagion risk emanating from the Gaza conflict. This week, that changed. Traders will begin pricing some risk the conflict will spread to include Iran. Bob McNally is the founder of Rapidin Energy and longtime friend of the show. Bob, good to see you this morning. Contextualize this for me. We don't know how the proxies will react. We don't know what the reaction function will be from Iran. Give me the scale of geopolitical risk premium that has been imbued into the market, and how much is it underpriced? Good morning.
Good morning, Manus. So we are in an escalatory dynamic that until this week, the market is largely shrugged off. And the escalatory dynamic is largely between Israel and Iran. And at risk is the 25% of global oil, seaborne traded oil, that is produced in and flows from the Arabian Gulf. About 20% of LNG as well, by the way. That's the risk. The market has largely ignored this since early November, when Hezbollah said we're not going to open a second front. But it's coming back into the market. Why? Because Israel escalated by, for the first time, directly attacking an Iranian diplomatic facility. And Iran is going to have to respond in some form of commensurate retaliation. So the market is saying, wait a minute, whoa, this isn't just about Gaza or even the Red Sea, which is just a shortcut issue. This is about the threat to the world's strategic oil and gas supply and trade. So that's why we're starting to price in this risk premium.
So this is about the Strait of Hormuz. This is about a geographic shift. You think there could be a risk of a shift from the Red Sea to the Strait of Hormuz, and that, you say, the geopolitical risk premium at the moment is $1. So we're underpricing by approximately how much? What is the risk if there is a serious escalation to supply, Bob? You've seen them before, but we don't know the quantum so far. Where do you think this could take us to in oil prices on an escalation risk?
Yeah, so my colleagues and I, we've modeled, an interruption in the flow from the Strait of Hormuz, and it's also the oil produced in, like Abcake. It's onshore production facilities and the choke point. All that's a $40. If that gets interrupted, that's a $40 rise in oil prices until we hit. It'll cause a recession. Now, Rapidin has had a 30% probability of that occurring. The market until this week was about 0%. It's priced in a little bit, but we think it's going to go higher. So this is a $40 delta if it happens, with a 30% probability, according to Rapidan, the market just beginning to price this in. We think there's at least another $10 in upside, just as the market starts to understand the risk, not the actuality, but the risk of a disruption.
Okay, well, let's all hope that we don't end up there, both from a human point of view and indeed from a market and risk to the world economy point of view. Let's just step back. Let's just de-escalate ourselves a little bit for a moment, because I also want to know how tight this market is. 2 million barrels a day are off the market by OPEC+. Mexico are stepping back from their deliveries in terms of exports. I have a rebounding China economy. The Saudis are raising their prices there. Those three separate things coalesce to give me a much more solid floor in WTI at 85 and Brent at 89, or perhaps even squeeze this market into a deficit earlier than we thought?
We are definitely on firmer ground fundamentally, Manus, as you said. Big change from the fourth quarter. We're starting to see stocks draw onshore. There have been expectations of big draws last quarter, didn't materialize. They're starting to show up now. Spreads, time spreads, are moving deeper into backwardation. And so cracks, refinery margins are quite good. And so when those refiners come out of maintenance this spring, they'll be chasing those cracks, drinking in crude and producing gasoline and diesel. So it is a much firmer market. And Chinese macro, as you mentioned, readings, especially on the production side, the PMI side, manufacturing side, have been positive. So macro has been helpful. The fundamentals, as we see them, are firming up. Price signals are showing a tightening market. It's not a super tight market yet. We still have a good chunk of spare production capacity, 4 or 5 million barrels a day, depending on who you believe. But it is a market that is on firm fundamental footing, no question.
Do you think Prince Abdulaziz bin Salman would be happy with 90 and would welcome $100 oil? We've got the $100 oil notes coming back in. Leave aside the geopolitical risk for the moment, Bob. I know it's hard to disaggregate, but we're both conjecturing on a delta and a probability in terms of the $40 oil premium that you're talking about. But from a construct of a market at the moment, how real is $100 oil in the near term?
I think $100 oil is entirely real. It just requires a little more risk pricing on the true geopolitical risk, as we discussed.
Yep.
I think in terms of the Saudi leadership, though, we've had this conversation many years now. I don't think they target a price. I really don't. They did that in the 80s. I think they're most concerned with inventories. Inventories not building too high or going too low, because that's what unleashes price volatility, and that's the enemy of OPEC Plus and arguably the world. So I don't think he's looking at 90 versus 100. I think it's all about our inventory is going to be stable. Menace, the great debate this year is over demand. And demand has been the surprisingly bullish element here, even in Europe, which is on its heels economically. Gasoline demand quite perky. The United States, same thing. So I think the Saudis and OPEC, they have a very robust demand growth estimate, as we know this year, over 2 million barrels a day. I think they're looking at more the health of that demand forecast than any given price per se.
And there are many grey swans on that front. We just had the first conversations over the start of this week about a growth slowdown in the United States of America and indeed in the rest of the world. But there's two sides to every trade. With that in mind, then, of course, you will be in Vienna in June. I may well be with you. Do you expect any nudging of the 2 million barrels a day that OPEC Plus have held off the market? If we hold at these prices and if things continue, Bob, there could be a building case to release back some of those cuts.
Absolutely. I think a tapering of the cuts, so some small increase in production by those members that have withheld production, will be on the table when you and I gather in June in Vienna. However, our base case is they'll be cautious and wait until October before bringing those barrels back. As you mentioned, Manus, there are macro black swans out there. And I think they're going to be cautious in returning the oil. So on the margin, I'd give it a little bit to a little longer of an extension, but certainly, especially if we get to May, demand readings are strong, inventories are drawing still, I could definitely see some tapering starting then.
How uncomfortable is the White House with gasoline going higher? I mean, do they have SPR that they can release? They've sort of cancelled some of the buybacks. How politically uncomfortable, you have knowledge of the White House firsthand, how unpalatable are these gas prices at the pumps in an election year?
No. We know the alarm bells are clanging inside the White House DOE. There's no question about that. So they are in emergency mode. Just last night, it was reported that they've ceased filling the SPR. So the refilling program they've been undertaking has been suspended because prices are moving higher. And they can do another release. That would be controversial since they depleted the reserve so much. But you can never rule out the steps, the lengths the president will go to fight high pump prices, especially in an election year. What would be worse, though, is if they looked at restricting exports of gasoline and diesel. After the LNG pause, that would be a big blow to our allies. I don't think they'll go quickly there, but you have to watch that. You have to watch NOPEC coming out of Congress. But an SPR release, unfortunately, is on the table. The main thing, you can bet, they may not be public, but you can bet they'll be quietly calling their friends in Riyadh and Abu Dhabi, asking for more oil at that June 1 OPEC Plus meeting.
Quiet messaging. Well, there's a convoy of the administration going to the Middle East, we understand, from the political front. Who knows what else they will discuss when they are there. Bob, thank you so much, as ever, with your insight to the markets. Bob McNally of Rapid Energy. Quick snapshot of where we are on markets. This is the S&P 500 down by 0.2%. Again, just jolted by higher rates. But we've just had a conversation with RBC, the bond team there, and they are seeing real money come in and snap up these bonds at these levels. So you are just seeing a little bit of temperance in the bond market, 436, and the dollar is flat at 12.47. Good morning from New York. Coming up in the show, we'll give you the diary of what needs to be done for your agenda. This is Bloomberg Brief. I'm Manus Cranny in New York. Let's take a look at the rest of the day. What's in store? More economic data. The ISM Services hits the tape at 10 a.m. Eastern. The chair, Jay Powell, delivers his remarks at Stanford, 12 p.m. Eastern. Plus, more Fed speak throughout the day, including Raphael Bostic, Austin Goolsbee, and Michelle Bowman. You can never have enough Fed speak, can you? Now, Intel, we've been checking this price through the morning. We're down 5.1%. Their losses are deepening at the factory network, and it warned that the business may not break even for several years. Stellantis, on the other side, down 2.8%. JP Morgan sees revenues and volumes down in the first quarter, so they're keeping an eye on that. And Disney, what movie comes to mind when you see the word Disney? We're taking a straw poll here. Some say Frozen. That's what I think. Anyway, others say The Lion King. Anyway, Reuters reports that Disney has secured enough shareholder votes to defeat the challenge against its board, mounted by Nelson Peltz. Now, Elon Musk says he definitely would buy the shares if Peltz was on the board. So, stock at the moment down at 0.6%. That is it for a Bloomberg Brief. Bloomberg Surveillance and the team will take you through the next 3 hours of programming, setting the agenda on Bloomberg. Good morning.